Hello, this is Greg Giardino, and I'm joined here with Steve Craffen, and this is It's Your Smarter Money. So today we want to talk to you about how to invest like an endowment. So some of these big endowments, historically, they've had some pretty decent performance and uh, different risk-adjusted returns. And today's video will really go over how to invest like an endowment and maybe how not to invest like an endowment to perhaps get some better
Yeah.
risk-adjusted returns. So with that being said, I'm going to swing things over to Steve, and we'll talk to you more about how to take an academic approach to your investment portfolio.
Yeah, and investing like an endowment became really popular after a book that came out by the fellow who ran the Yale Endowment Fund. His name was Wenson, sadly passed away. And at least on paper, he achieved very high rates of return. But, there's a lot of things there that are not quite the same. In fact, we've seen a lot of the returns on endowments are now starting to decline because some of the investments they use, they were able to take advantage of things that the average investor cannot take care of, but also these special investments are sort of experience a repricing. Now, when more and more people and entities have gotten into them, what's happening is what typically happens with investments. A lot of the excess return has been arbitraged away. So we're going to kind of talk about the upsides and the downsides of investing like an endowment. All right. So what does it really mean to invest like an endowment? Well, it means that you're trying to diversify and reduce risk. And if you reduce risk, you have more stability in your portfolio, which is an interesting thing because of the mathematics, you end up with more end of period wealth. And the reason is because volatility actually affects your return. And the actual return you experience, which is the compound rate of return, is different than the average rate of return. And the difference is related to the amount of volatility in your portfolio. So how do you actually invest like an endowment, though? One positive about what they do is they invest in many different asset classes and some non-traditional asset classes, and which we're going to cover here, by the way. They take a long-term focus, they rebalance, and most people who invest on their own don't really rebalance. And rebalancing is an important thing to do on a regular basis. It does a couple things. First of all, it helps you maintain the risk profile of your portfolio because some things will grow more quickly than others, and typically it's the higher risk investments that'll grow more quickly. Okay. Second thing it does, it also allows you through a formula to sell high and buy low. Because if you set a rebalancing threshold, an asset that's appreciated more greatly in relation to the rest of your portfolio, well, it may become overweight in your portfolio, and also it may have sort of almost like the rubber band you pull may have reached the end of its stretch. And you may have an asset that's overvalued and may be a great time to sell some of it, take the profits and take some of it off the table and buy something that may be undervalued and hasn't performed as well. And additionally, actually, we did another video on this recently. There's also a spending policy. They have spending policies in endowments. They typically spend only 3 to 4% of their holdings each year. And endowments, whether they be a pension fund or an endowment, typically you may think of a college endowment. They use that money to help support the students and also their costs at the college. So this is a famous fellow from finance. His name is Merton Miller, and he said diversification is your buddy, and clearly it is. And a lot of people, you may have heard this phrase, say diversification is the only free lunch in investing, despite what people think. So how do you not invest like an endowment? These are the areas where you have to be cautious. Endowments, they tend to buy some private investments, many of them, and I think that may be gradually changing because they're beginning to realize that a lot of these private investments are overpriced. For example, private real estate, hedge funds, structured notes. So I recommend you avoid these illiquid investments. Additionally, a lot of these private investments have what we call idiosyncratic risk. That's risk of a single manager. And a lot of times these single managers, they may not diversify properly. And additionally, endowments were taking advantage of what we call the illiquidity premium because these investments are not really particularly liquid. And so there you get a premium in terms of return because the asset is not quite liquid. And it may take you a while to actually sell it and bring it back into cash. That's okay for an endowment that effectively has perpetual life and never dies. But for an individual, you really can't you don't want to take advantage of that illiquidity risk. And we've seen some particular private investments that it could take you 10 years to get your money out. And it could be restrictions even before that for some that don't have a 10-year period. So I would recommend you be careful. But here's the traditional versus the endowment style. Traditional, here's a 60-40 portfolio. You probably have heard of that. 60% stock, 40% bonds. But in the endowment model, you would diversify much more broadly among a number of different asset classes. We're going to talk about some of them here. We can't cover all of them today, but there's a number of non-traditional investment types you should consider. We're also going to discuss in a minute what is actually an asset class, by the way. You want to have different asset classes in your portfolio, okay? And so what is actually an asset class? Well, an asset class, this is a way many people define it. First of all, it should have a stable composition. It should be investable. So, for example, years ago, you couldn't invest in commodities very efficiently. Now you can. It should be internally homogeneous. That means the investments in that asset class should be very, very similar to each other. It should be externally heterogeneous, which means they should be different from other types of investments. If they're different, they're not part of the same asset class. It should if you add it to your portfolio, it should enhance utility in your portfolio, or what we call portfolio efficiency, which means that it helps with diversification. There should be no skill required in selection. For example, the S&P 500, you could buy an index. There's no skill required there in selection. Additionally, you should be able to get it cost effectively. Okay, and you can with so many different asset classes now, which frankly didn't exist 20 years ago, by the way. So here's our ranking of, or I should say, a table of asset classes that, in our opinion, on many of them. And you see, we do recommend many of them, but there's some we recommend you avoid for various reasons. Now, there's a lot here, so we're going to have to get through some of this pretty quickly. But so, for example, we don't recommend corporate bond funds. Quite honestly, corporate bonds are really not generally a good deal for the bondholder. They're a better deal for the corporation, quite honestly. And corporate bond funds exhibit a lot of the risk of corporate stock associated with that company. And you also have to be highly diversified among corporate bonds, like you do with corporate stock. But you also have to be careful about credit downgrade risk and also default risk. We don't like high yield bonds. Again, they're just corporate bonds that are BBB and rated lower. They're just junk bonds. And they've had a 6 to 8% default rate over the years. We don't really recommend high yield bonds. And if you look at it, they move very high in conjunction with the stock market, very closely correlated is a term. And preferred stock is mispriced because preferred stock is a unique instrument. A company could buy the preferred stock of another company and they get a significant tax break. So that creates a mispricing. We don't recommend preferred stock. Effectively, you have the risk of stock, but none of the growth of stock because typically the growth is capped by the dividend, which is typically fixed. So you don't want to have preferred stock. And while you may have heard about emerging markets, we don't recommend emerging markets for many reasons. There's another asset class we recommend in its place, which we will talk about shortly. So these are the main top investment classes we're going to talk about today. Bonds, reinsurance bonds, which are a very unique and interesting asset class. Convertible bonds, which quite honestly, most advisors don't use for some reason. I've been using convertible bonds for 30 years. Real estate, but real estate mutual funds, natural resources, international small cap, which we recommend in the place of emerging markets, and also hedge fund strategies, but not through hedge funds. So what's the purpose of bonds in your portfolio? Well, it's really meant to add stability and to provide a reservoir of wealth that you know you can safely tap no matter what happens with the market, the stock markets, the equity markets, and also the economy. So fixed income should provide stability. It should act as a source of funds, even in a worse market, something you can sell if you need cash, and it would not have declined in value. This should have little inherent risk. It shouldn't have much default risk. Or credit downgrade risk, which corporates have. And it should also experience very little what we call idiosyncratic risk. That's the risk that's unique to a specific company or debtor or provider of the instrument. So these are the categories that we recommend and typically buy for our clients. Municipals, especially what are called general obligation municipals, as opposed to single purpose revenue based municipals. Real quickly, the definition is this: general obligation municipals are typically backed by the taxing power of the town or state or entity that issues them, as opposed to revenue municipals, which are backed by the revenue generated by a single project. For example, and by the way, I don't mind projects like sewer systems or water systems, because those are fundamental need types of projects. I'm talking about stadiums, parking lots, things of that nature. Whereas if that particular entity fails or that the revenue declines, you're at risk to the bond defaulting. So we don't recommend those. Treasuries are unique, and we're going to go over the little chart showing these in a couple minutes. CDs, which have almost no risk, especially if you keep below the FDIC thresholds for a bank. Reinsurance bonds and foreign sovereign bonds, which we're not going to cover today, but we like foreign bonds, but only bonds of foreign sovereigns, which are foreign government providers. And by the way, only the safest providers in developed countries. So here's a fixed income classification, and we kind of break it down into three categories: non-taxable, taxable, and non-traditional. Now, non-taxable municipals generally issued by towns and states. Also treasuries, but treasuries are only non-taxable on the state level, but they're taxable on the federal level. Then, of course, we have the taxable bonds, which include corporate bonds. We have the default risk there. CDs, which are generally protected by the FDIC. Taxable munis, which can have a use depending, and also government agencies. But the non-traditional bonds include convertibles, which we're going to cover today, and also reinsurance catastrophe bonds. So let's talk about those next. Now, that's a really unique asset class. Now, it sounds like, gee, I don't want to be involved in something that's involved in a catastrophe, but reinsurance catastrophe bonds have been used for probably about 30 years, and there's some well-known people that have made fortunes on them. Now, we're not going to suggest you're going to make a fortune on them, but they do provide a significant return. In fact, the return on our the mutual fund we use for reinsurance bonds is average about 8% a year for the last 5 years. So it has an interesting structure. What happens is insurance companies, for example, let's just say, I'll throw out the Hartford. They may, and I don't know if this is true about them or not, but they may have a lot of risk in a certain region, because a lot of times insurance companies are very regional, and they may have a lot of risk in relation to a certain event, for example, an earthquake or a hurricane. So they know that they're concentrated in that type of risk. What they like to do is they like to transfer that risk to a reinsurance company. So reinsurance companies are the insurers of insurers. And so what happens, though, even with the reinsurance companies, they like to transfer that risk to others as well, some of that risk. So what happens is they set up this, what's called a special purpose trust, an SPV. And in this special purpose trust, they actually sell bonds to the public. And there's a contract between this trust and the reinsurance company. And the special purpose trust collects income from the bonds they sold to the public. And so what happens then is, in the contract, if the reinsurance company exhibits a specific type of risk, which is outlined in the contract with the SVP, for example, a hurricane with loss exceeding a certain limit, they're allowed to tap the money in the SVP. Okay. And that helps indemnify them against this unique risk. So this sounds like a pretty risky thing. What happens, though, is the insurance company pays a premium to the SVP effectively to create this type of insurance, and that premium goes to the bondholders, and that's how the bondholders receive income on the bonds. So what happens with the mutual fund, they'll do probably 200-300 as SVPs, diversifying this risk of many types of events, many types of earthquakes in different locations, hurricanes, fires, that type of thing. And so you might say, gee, this sounds like a kind of a scary thing. Well, but it's really provided really good return long term. And you can see these returns. The average annualized return over about a 30-year period, this is an index, has been about 6-7% a year, with a very low amount of volatility, which we rank in terms of standard deviation, and a very high Sharpe ratio. And each Sharpe ratio is the relationship between rate of return and risk. And like I said, we've been averaging about 8% return in the mutual fund we use for reinsurance bonds. And what's great about it, it has almost no relationship with other assets in our client portfolio. It's had very few really bad years. Even in the year Hurricane Ian hit, for example, I think we were down maybe only 2 or 3% in with the reinsurance bonds. And even in years when, for example, 2022, when bond mutual funds really got hit when interest rates rose, we saw almost no effect with the reinsurance bonds. So it's a phenomenal diversifier. So the next one is I'm going to jump into convertible bonds. Now you may or may not have heard of convertible bonds, and they're a very interesting instrument. They've been around for years, since the 1800s, and it's interesting that most advisors do not use them. I've never understood why. So a convertible bond is a bond issued by a corporation. It's one of the few places where you will actually use corporate bonds. And the reason is because there's a catch to this type of bond. They have an option attached to them, which enables you to convert the convertible bond into the stock of the company. And so that's really interesting. What happens there, you almost have the best of both worlds, because with a typical corporate bond, the only real gain you have potential there is the coupon on the bond. You're not going to exhibit any growth. With a convertible bond, you can actually profit from the growth in the stock of the company. And what happens with a convertible bond, you see in a minute, we have a graph that shows you this. When the price of the stock goes above a certain level, you're going to see that the price of bond tracks the price of the stock. So it's a really interesting instrument. So we've seen that the risk is about 60% of the stock market, with a return, as you see in a minute, where the return is really, really close to it. So how does it work? Well, typically you may have a conversion ratio. They may say, argument's sake, $1,000 bond, you can convert it into 20 shares of the underlying stock. And we're going to show you that conversion ratio in a minute. So that means that if the stock price is $50, you can convert the $1,000 bond into 20 times $50 or $1,000 in stock in the company. Okay, so now if the stock declines, the arguments say $40, you'd only get $800, so you wouldn't convert. Typically, the conversion is at the choice of the bond holder. It's not at the choice of the company. So this option really works in your favor with a convertible bond. So you have that ratio. You have the bond's par value divided by the conversion ratio, and that's the conversion price. Now, I mentioned the stock was at 50 and the ratio is 20, you have $1,000 in stock you can convert the bond into. But if the stock goes up to $60 a share, now suddenly your bond is worth $1,200, because you could convert 20, you can get 20 shares at $60 a share or $1,200. So you can see what happens is when you start to go above that equivalent conversion price, the bond's value starts to track the stock. Okay, so you sort of have the best of both worlds here. You have a instrument that has a floor when the stock market goes down, because at that point, what happens is the value of the bond is based on the coupon, because these bonds do have a coupon or interest payment associated with them. The bond's value will be based more on a coupon than the stock price. So there is a floor here, which is very nice. But you also have almost no limit on the upside with this type of instrument. So you can see how convertible bonds, this is going back to, I think, the 1990s, these numbers have averaged about 11% a year, whereas the stock market was around 11.65. But look at the difference in risk as measured by the standard deviation. It's, as I said, it's about 60% less. And by the way, convertible bonds are doing quite well this year. They're up around, I think, around 7 or 8% this year, and they're up about 10% in our portfolios last year. So it's a very, very great ratio of return in relation to the risk. Okay, next, we talked about bonds we think you should avoid. Corporate bonds, I mentioned why I think you should avoid them. They're not always a great harbinger of value and market declines. They also require significant diversification. You also got to monitor them closely, because if a rating agency starts to reduce the rating of a corporate bond, a lot of times there's a delay that when they reduce their rating, and it could be something that could almost like a snowball running down down a hill, picking up more snow. There could be a really bad event happening quickly on the horizon. It could be downgraded even further, or could be close to default pretty quickly. So you got to monitor corporate bonds very closely. Corporate bond funds, we don't recommend corporate bond funds because they're really sensitive to interest rate changes. And we saw a lot of them decline dramatically in 2022 when interest rates went up. We saw some corporate bond funds go down 15, 18%, which is that's a big hit. And in a corporate bond fund, it may take you years to recover that value. Could take you 3, 4, 5 years to recover that value. Also, we recommend you be careful regarding callable bonds. Callable bonds are almost like the difference, exact opposite of convertible bonds. The company can call a bond, and typically they're going to call it at the worst time for you. They're going to call that bond when interest rates are high, and they can I should say, are low, and they can refinance that bond at a lower rate, which means you're losing something where you thought you were going to get maybe a 6% coupon on, and you locked in a nice rate, you thought. But now rates have gone down to 4%, and the company's going to call that bond. And guess what? You're stuck now with trying to reinvest that money at a 4% coupon. And additionally, callable bonds, they create part of an upper limit on how much a bond can appreciate above par if interest rates decline. I mentioned high yield bonds. We definitely do not recommend high yield bonds. They act like company stock. They don't really provide a good reservoir of value. And quite honestly, I would take convertible bonds over high yield bonds any day of the week. You have to consider high yield bonds are not really something that should be considered part of fixed income because of their high risk. And also, I mentioned these single purpose revenue bonds. Those are bonds that, as I mentioned, they generate their revenue by a single project. And like I said, if it's a project like a sewer system or a water system that's a real need is real need related to something that's never going to exhibit a decline in need, that's different. Whereas like a stadium or something like that, you just don't know what can happen. Okay, next asset class, real estate. But we recommend publicly traded REITs. I don't really recommend private real estate generally. A lot of times, a private real estate, you're dealing with one manager who may not be diversified on a regional basis. They may not know different types of real estate. They may not have the flexibility to move around because, believe it or not, real estate is one of the few areas where we think active management actually adds value. Generally, we don't think active management adds a lot of value. We have the numbers to prove this for asset classes that are very efficient, large cap stocks, mid cap, and also for small cap too, for a great extent. So we really recommend active management in this area. So this shows you what the odds are that you'll actually do better than a benchmark using active management. And you can see here, for example, in large cap stocks, those are the ones that are in, I guess, purple. You can see there that as you go through time, for example, even 10 years, you see that the average success rate for most of those types of funds that have active managers in terms of them beating their index is pretty low. Whereas with real estate, or most of the ones in the quadrant to the upper right, you see that they have a high probability of beating their benchmark even over long periods of time. And there's a reason for that. So, for example, an active manager in real estate can say, gee, okay, warehouses are doing much better now because of the fact that a lot of people order stuff online now as opposed to going to malls. And malls aren't doing as well because we've seen that a lot of the chain stores, for example, Sears and others, are shut down because people are buying things online now. And so it makes sense for for these real estate managers to go into other areas of real estate, as I said, warehouses, cell phone towers, storage facilities, that type of thing. And so an active manager will see these changes that are really structural in real estate and make those changes. And so, by the way, real estate has outperformed stock, the S&P, since the year 2000. If you add in go back to 1990, it hasn't, but since 2000, it's outperformed the stock market, and pretty dramatically as well. These are average rates of return per year. And so real estate's been around 9.9%, stock market around 7.7%. So that's a substantial difference. And so you see here, this is a graph of that, and you see that a $10,000 invested in real estate since 1999. This is a Morningstar Real Estate Total Return Index. You would have about $95,000 today versus only about 68,000 in the S&P, which that's a significant difference. So I'm not saying you should eliminate S&P in your portfolio. No, you should have that as well, because there's always we see changes, and you're going to see that soon when we talk about international as an investment. There's a lot of rotation in the world of investing. What happens is something does really, really well. By doing really, really well, it becomes overvalued. And so then we start to see what we call return to the median, or return to the average. And so something that did really, really well may not do as well for the next 5 or 10 years because it became so overpriced. So we don't recommend you necessarily go to all one asset class. You need to be diversified. But real estate has been a phenomenal asset class. Additionally, it hasn't really moved in lockstep with the stock market through time. Now, there are times when it does move in lockstep, but there are also plenty of periods of time when it doesn't. And we measured that relationship between the performance of one asset class in relation to the other in a statistical term called correlation. But you do see the correlations aren't static. You can see that the correlation of REITs, which are real estate investment trusts, that's actually how you invest in real estate. Most mutual funds who invest in real estate buy REITs, okay, and they're you can trade them on the stock market. But you can see that now the correlation is actually only around 0.8%, 0.79. And that's when a correlation is below 1, that means that having that asset class in your portfolio enhances portfolio efficiency. And it means that not everything is moving a lockstep, and that when some things are down, and you're going to see that actually in a minute or two with international, other things are up. And so it actually improves stability in your portfolio. With that, now I'm going to hand it over to Greg, who's going to talk about 3 or 4 other really important asset classes.
Thank you, Steve. So let's talk a little bit about natural resources. So why would we consider natural resources as an asset class, especially against inflation? Well, for starters, natural resources typically are a store of value, right? They're tangible, hard assets. So that is very attractive to a lot of investors. Additionally, resources are in global demand. So this can also work as a little bit of a hedge against the US if for some reason demand goes down for different natural resources. So we have some on here that we like: oil, natural gas. Gold is in here. I know there may be some gold bugs on this call here, but you'd be surprised, even though gold has had a really good year here in 2025, if you look at it historically speaking, it does have some inflation protection, but it's not perfectly uncorrelated. So whenever inflation is up, it doesn't mean gold is always up. I believe historic correlations have been around like 0.18. And actually, in some instances, there's some studies where if you add too much gold to a portfolio, it actually doesn't necessarily decrease risk and increase reward. It actually does the opposite. So just be careful with that. We think gold can play a valuable component of natural resources, but if you start to get above 5%, it's a little too much, in our opinion. Additionally, we have here the Bloomberg Commodities Index, BCOM, that is in the gray here on the graph. And then we're looking at it as it tracks the consumer price index. So the consumer price index literally just means tracking a basket of goods and services over time in relation to price. And you can see here there is some correlation between the Bloomberg's commodity index and the consumer price index as well.
Especially in when we had the last bout of inflation, right, Greg? Like 2022, I think. Right?
Yeah, and looking at this graph, I think it goes to maybe April of 2020. We could see it was pretty close. And then we had the COVID coronavirus where we saw supply and inflation really spike. So pretty interesting graph here. So we have a correlation table looking back from May of 2022 to April of 2025 here. We could see at the top left in blue if the correlation of the Bloomberg Commodities Index as a 1, we could see how uncorrelated it is to different asset classes. So I know Steve talked about earlier reinsurance. We have an index for that. It's about half the correlation. We have the EFA index. For those of you who don't know, that's Europe, Asia, Far East. So that's an international index proxy. We also have the Russell 2000, which is the top 2,000 small companies, S&P, which everybody knows, and the Wilshire Index is really a proxy for an index for outside direct investment into real estate. So we can see you want to have things in the portfolio like commodities that aren't necessarily going to move in lockstep with some of these other stock market indexes. All right, so we'll talk about hedge funds here, right? This is gets a lot of press, right? It's a lot of hype here, in our opinion. But with hedge funds, right, you have Ray Dalio with Bridgewater Associates, some of the most famous ones. You also have Pershing Square with Bill Ackman. So like these are the best of the best. And a hedge fund, in a way, is like its name, right? Hedging your bets. How do you historically, and once again, I'm going to generalize here, not every hedge fund is the same, but they typically want to capture maybe 70% of the upside of the stock market, US stock market, and maybe 50% of the downside. So they try to get a return and risk profile that's less than investing in the US stock market, but capturing a lot of the gains. And one thing that hedge funds are notorious for are their high fees or their high expenses. They have something called 2 and 20. And as Steve will show on this line, if you look halfway down, typically you'll pay an annual management fee of maybe 2% a year. And any profits that the managers exceed, you typically have to pay 20% in profit or 20% in excess return. So this can get very expensive over time. Now, there are some high minimums to hedge funds. Yes, there's quite a few that maybe have $1 million starting point or $2 million starting point to even get in. And one of the things you have to be careful with hedge funds is, unlike public investments that have to publish quarterly reports, these are not very transparent because hedge funds are private investments. So remember that not only are they not transparent and they don't have to release information, but also it could make your overall holistic portfolio hard to rebalance because that's going to be in a separate account and you really don't know exactly what's going on in the hedge fund and how
I
they're
just want to
investing.
mention too is that endowments have been able to negotiate better fee structures with hedge funds because they have so much more money to invest. And now what's happening is you're starting to see some of the endowments and pension plans. It's impacting the performance, even with the negotiated fees, they're still quite expensive. So private hedge funds can be really, really costly.
And to add to that, that's a great point, Steve. And historically speaking, if you look at the hedge fund index, prior to the great financial crisis, the returns were a bit better for institutional investors. But ever since the great financial crisis in '08, hedge funds, if you look at that index, the returns haven't been that favorable. And I think a big part of that is really the fee structure.
Yep, definitely. Yep.
So there's another strategy with some hedge funds they'll utilize, and sometimes outside of a hedge fund, called market neutral. So what essentially that does is you may pick the winners, that companies that you think are going to do well. Let's say I'm going to do 100 buys, 100 different stocks, and then you offset it with 100 different shorts. So in effect, if you have 100 that are positive and 100 that are negative or shorts, hence the name market neutral, right? And what they'll do is they'll have a side money market account that will essentially pay you profits if there are any differences in the winners versus the losers. And once again, this is maybe more of a lower volatility strategy. And historically speaking, Steve, correct me if I'm wrong here, but the average return expectation is usually around 6 to 8% a year.
Yep. For market neutral, maybe even below if they balance the shorts and the longs. To me, it's closer to around 5 because they profit mostly by investing the cash that they get by selling the shorts in treasuries.
And here's just a further explanation on market neutral. Now, you can also, with some long short portfolios with hedge funds, they can take a direction, meaning it
Right.
doesn't have to be a perfect offset. You could say, or they may mandate, well, let's try to do 70% longs and 30% shorts so that you're
Yep.
more weighted to a long only position. So once again, just something to be mindful of when you're looking at these different endowment type strategies and asset classes.
Yeah, and it's the long short funds. They actually call themselves long short funds, which you brought up, Greg. They're the ones that'll have the potential to achieve a higher return, but of course, with greater potential for downside capture, what we call downside capture.
Now, convertible arbitrage, I know Steve alluded to this in the beginning, especially with convertible bonds, which you
Yeah.
get the best of both worlds. You can almost have a stock-like appreciation to a bond. Once again, it's not going to perform exactly like the US stock market, but can give you maybe a 60% or I'm sorry, 40% reduction in risk, as we
Hmm.
saw in some of the numbers earlier.
Yep. Yeah. And with convertible arbitrage, what they do is they'll buy the convertible bond and sell the stock, hoping to take advantage of a mispricing between the convertible bond and the underlying stock. And you know, they can make small gains here. It's not a real aggressive strategy in terms of return. I think they're looking at maybe a 5 to 6% return potential in the long run for this type of approach or strategy.
Now, merger arbitrage also deals with pricing inefficiencies, specifically when it comes to a company that's being acquired by another company. So essentially, what happens is the acquiring company has a set purchase price, and essentially the company being acquired, their stock price will start to jump and get closer and closer to that acquisition price. And
Yep.
actually, of course, there's time that goes by to see if the deal goes through. And there's actually a little bit of a discount that typically happens because you don't know when the deal exactly will follow through and be implemented. So
Yep.
usually that could be an 8 or 10% discount that the
Yep.
manager can take advantage of. And as a result, this is another strategy that has no direct correlation to how the stock market's doing. It's literally dependent upon this deal. But also,
Yep.
there's some risk to this because if the deal falls through, well, then the company that was acquiring the company, that stock price will fall. So, once again, I
Yep.
think this is another strategy that has its place in certain percentages, but something that some endowments will employ within their strategy.
Now, I just want to mention something here is that what they'll also do, by the way, they'll buy the stock of the firm being acquired, and they'll sell short the stock of the firm doing the acquiring because studies show that typically the acquiring firm's stock actually declines in price. So they take advantage of that by selling it short, and so they kind of earn that difference between those two changes and the acquiring firm and the of the firm being acquired. So it's sort of they call it arbitrage, because that's what effectively what they're doing. So it's an interesting strategy, and it has almost no correlation to the stock market.
Now we have another correlation matrix here. So once again, looking from 2022 to now, or I'm sorry, to March of 2025, we could look at that convertible arbitrage. Once again, the bond convertible arbitrage being a one, and you can
Yeah.
see long short, market neutral. We have the EFA index, which is for international and S&P. These are very uncorrelated. Once again, it's not perfectly uncorrelated, which is fine, but you want things that'll dampen the volatility within your portfolio. And I think the convertible plays a pretty good role in that.
One great way to look at this, by the way, correlation table is to say that the darker the color, the greater the correlation. Now, everything's correlated to themselves. That's why you see all those ones there, and those are the darkest. But you'll see that the lighter the shading, the lower the correlation. And when you see this, that means that there's potential to improve the efficiency of your portfolio by including that asset in your portfolio. And that's how correlation is useful.
Now, here's a chart that shows basically the downside risk going from 2022 to 2025. So looking at a drawdown period, and if you look at the y-axis here, we could see if it was a negative 5%, 10%, 15% return. you could see here that across the top, it's really hard to see, but convertible arbitrage really wasn't correlated according to the last correlation chart that we looked at. You could see here in green and purple, that's going to be the S&P 500, as well as the in green, the international index. So once again, just showing on the downside capture, this is what you want. You want there to be less losses so that you have more gains to recover and quicker gains to recover.
Yep.
Now, a lot of folks will have international large companies in their portfolio, which is a nice place to start, but there could be some further diversification benefits and potentially higher reward in international small companies. So not a lot of folks have this, but I think it's an asset class to pay attention to. And in our next chart on the next slide, we have a little bit more about that.
I just want to mention it's actually our best performing asset class this year. Our holdings are up about 25% this year in international small cap.
So if we look at the annualized historical annualized total return versus the standard deviation, you could see that in the US, it was a 10.5% annualized rate of return. Looking at international was about, small international was about 9.32. So the diversified portfolio would have done about 10.4% average per year. So once again, I actually misspoke, not international small, just international as an asset class as a whole.
That's right.
And you could see here with the Sharpe ratio, that is basically looking at the expected return per expected unit of risk. Once again, you want to have the Sharpe ratio higher, above half a point here. And you can see with the diversified portfolio, we get to 0.69. So definitely something to pay attention to when you're building out your portfolio to invest like an endowment.
Yeah, and international has gotten a bad rap over it because it has really underperformed domestic investments probably for the last 10 or 12 years. But you're going to see, we're going to show you later, Greg's going to show you what's happened prior to that. And we may see rotation back to international, possibly. We don't know how persistent it will be, but this year international is really beaten domestic.
So if we look at this table, it's really showing you the power of being diversified. From 1970 to 2025, we're going to look at a non-US portfolio, and then combining it. So we could see here on the x-axis across the bottom, that is standard deviation. It's a measure of risk, right? We want to have lower standard deviations. And then for returns on the y-axis, we want to have higher. And ideally, you want to be in the northwest quadrant. So you could see here, non-US versus US, risky inherently by itself. But when we combine them with the green star here, we can get a more efficient portfolio and a better result, historically speaking.
Yep.
And this is a nice chart here just showing you from, I believe, 2000 to January of 2010. How did the USA perform against the international index? And you can see here that they were pretty much in tandem. And then when we hit 2000 all the way to 2008, that was the lost decade. That's where US really took a hit. I believe the average annual return was in the negative single digits, maybe a couple percentage points, 3 to 4% a year. So US investors, remember, that was a terrible time to be a US investor. However, you could see here the cumulative return was negative 12.68% per year. And then the cumulative return for international was almost 26%. So you could see, even though in recent memory, international has been underperforming, you could see here that international did have its day in this decade, as you could see here based on the data.
Yeah, and it saved your portfolio, probably that and a couple other asset classes.
Now, from January 2010 to January 2020, I think we know that the U.S. really took off, right? So the cumulative return here, I mean, it's a pretty big divergence. We have 252% versus 79. So many folks that were chasing performance might have said, you know what, let me get out of international, which, as we know today, may not have been the wisest move. And it's very hard to predict. You don't know what asset classes will perform, but this just goes to show you don't know.
If I could predict it, I'd be on an island somewhere eating cracked crab and not even working, right?
Wouldn't be such a bad deal, would it?
Yeah.
And then year to date, so 2025 to 7/11, how's international versus US? Well, pretty
Yeah.
dramatically different story than the last graph we just saw. So the IEFA index, which is a proxy for international, is up over 18%. And SPY here, the ETF S&P 500, only 6.61%. Now, once again, caution to investors. Now's not necessarily the right time to be jumping in fully into international stocks.
Yeah.
Yes, international's doing well because the dollar is down. I think it's the lowest it's been since 2022.
Yeah.
But I think you need to find a sweet spot on how much international you want to have inside your portfolio and have
Yep.
the discipline to stick to it.
Yep.
So, once again, 2025 has been a very banner year for international so far.
So I just want to mention something. We use pretty advanced mathematics to help construct portfolios and also to uh, determine mathematically what the right mix is that's going to maximize portfolio efficiency. So we don't really do this using any kind of seat of the pants method. So there is a lot behind the scenes regarding how we construct an asset allocation strategy for clients.
Now, here's looking at cumulative returns from 2022 to 2007, and also from 2008 to the present. You could see here cumulative returns US versus non-US. It varies widely.
Yep.
And I know a lot of folks are wanting to jump on the bandwagon that maybe didn't have international exposure now, and that's precisely the opposite of investing 101. You don't want to be
Yep.
buying high and eventually selling low here. So once again,
Yep.
look at the historical data. Uh, Steve and his portfolios that he puts together really are optimized from not only a historical perspective, but going forward. And you don't want to be timing these things because it's just too hard to predict.
Yeah. Yep. Possible.
And this
Yeah.
further shows also a little bit more of a wider lens, right? If we go back from
Yep.
1970 to now, you could see it's literally one versus the other. And interestingly enough, if you look at historical performance, when the US stock performance yields 6% or less in return, you can see that international usually outperforms. So international
Yeah.
can also be a very good diversifier against US stocks, which is a good segue here. So you could see here,
Yep.
looking at correlations, if the US stock market is a 1, this is about 25% less in a correlation. We're looking at a 0.75. It's not perfect, but once again, international can have its day, US can have its day. It could be for decades, it could be for days. We don't know, but
Yeah.
you really want to have both.
What's interesting here is you see that there seems to be a general downward trend in terms of the correlation because for a long time international is highly correlated to domestic, but seems like it. Look, we don't know that this trend is going to continue, but it is becoming gradually less correlated, and that could be in part because of the currency, which you mentioned too, Greg. That's certainly a factor.
And then we also have to take a look at emerging markets versus international small companies.
Right.
Now, with emerging markets, that's some of the BRIC companies, right? That's Brazil, that's India, China, or Russia. And then
Yeah.
looking at this, we could see that emerging markets is maybe 0.60 on the correlation scale, and right below it is international small. So international small is pretty similar to emerging markets. It may not be as uncorrelated, but it's pretty close. And it's an asset class that we think you should also be considering because of certain metrics, which we'll share in the next couple slides.
Yeah. Also, we don't really I don't really care for emerging markets because a lot of those countries you mentioned have a lot of political risk, so we tend to avoid emerging markets. And I think the principal reason a lot of advisors using emerging markets is because of this low correlation and the idea that somehow they'll these countries grow more quickly than developed markets. We haven't really necessarily seen that to be the case long term, and I'm very concerned because a lot of emerging market funds have in anywhere from 25 to 35% of their holdings in China, which to me is a country with a lot of political risk. And you mentioned Brazil. That's a country that they're having a lot of political problems now. They're in Brazil. So I'm very concerned with emerging markets, but we think you can gain pretty much just as much of the supposed value you get from EM from international small cap value. And that value is a lower correlation with the domestic investments that you will see with international large companies. But the international small cap value that we use sticks to developed markets without that political risk.
Once again, add to your point, Steve, political risk is really hard to quantify.
Yeah.
And as you can see here, this is a chart going back from 1993, just showing you if you invested a dollar amount, where it would be today. And you can see here, emerging markets, you'd wind up with $476 versus $1,058 for a small international blend here. So something to consider for your portfolio. And there has been some good historical performance on it.
Yep. And so here you can actually see here the emerging markets fund and their exposure to China. So I really have a big concern with China because look, they're right now the United States' principal competitor, not just economically, but also I think militarily. And I'm always concerned also with countries that don't have strong constitutions and stable forms of government. And look, nobody really understands what's happening behind the scenes in China, and they've been threatening to invade Taiwan, both overtly and covertly for years. And if they invade Taiwan, all bets are off. We saw what happened when Russia invaded Ukraine. We never had anything that was invested in Russia, but some emerging market funds that were invested in Russia, those stocks became illiquid when that happened. So I have a real deep concern with emerging markets funds because of their high allocation, many of them to China.
A nice thing about investing in IEFA here, the international index, is you could barely see the black on here, meaning exposure to China. So it should be a lot more minimal, and that should help to remove some of that political risk from the portfolio.
Yeah, and you could. This is actually the holding that we use. We use the DFA International Small Cap Value Mutual Fund, and they have basically no exposure to China at all. And this fund's been a huge winner this year. It's up about 25% this year. It's had a really solid long-term return. Even though the last 5 years annualized about 11 to 12% a year for the last 5 years, but it doesn't have that political risk. So, Greg, why don't you sum things up?
Sure. So we hope you learned a little bit more on how to invest like an endowment, but taking maybe some of the not so good pieces out so that you could really have a nice risk-adjusted portfolio. Our team really specializes in, I guess, excluding some of these private investments that may not have the advertised effect that they pronounce in a portfolio. We really look at some of the academic data. We also look at it from a mathematical perspective. So once again, our team is here. We're happy to help. And if you have any questions, if you're interested in investing like an endowment, but more streamlined and maybe more cost effective, in our opinion, we'd be happy to help.
And I just want to mention that this is part of a continuing series of videos we're going to be doing. And they typically are in conjunction with an article we write in MD Life. But this video is going to be recorded and it'll be available on our YouTube channel and also a channel we have in Wistia and in those two areas. And it'll also be part of a playlist there as well.
So with that being said, we hope you found this valuable. And until next time, we'll see you soon. Take care.